Elon Musk. The name itself is a brand, a symbol of futuristic ambition, technological disruption, and astronomical wealth. Today, he stands as one of the richest people on the planet. His ventures reach for the stars, reshape our roads, and even try to connect our brains to computers. But this empire, built on innovation and audacity, was once teetering on the edge of a cliff, just one single decision away from complete and utter collapse. To understand how he built this fortune, we must first understand that Elon Musk does not think about money the way most people do. For him, money isn't a scorecard to be admired or a treasure to be hoarded. It's a tool. It is fuel for the engine of creation, meant to be deployed, risked, and leveraged to build things of lasting value. This philosophy was put to its most extreme test in the early 2000s. After the sale of PayPal to eBay, Musk walked away with a personal fortune of around $180 million. For most, this would be the endgame, a lifetime of financial security. For Musk, it was just the beginning. It was seed capital. He proceeded to do something that baffled the financial world and horrified conventional investors. He took nearly all of his winnings, his entire fortune, and plunged it into two of the riskiest ventures imaginable. The first was SpaceX, a company with the seemingly impossible goal of making humanity a multi-planetary species. The second was Tesla, an electric car company at a time when gasoline was king and electric vehicles were seen as little more than glorified golf carts. He didn't just invest. He went all in, betting his entire net worth on two capital-intensive industries with historically high failure rates. This decision was not just risky. By all conventional measures, it was reckless. It was a move that would bring him to the absolute brink of financial ruin. The year is 2008. The world is gripped by the worst financial crisis since the Great Depression. Credit markets are frozen, and panic is the new normal. For Elon Musk, this global catastrophe was amplified into a personal perfect storm. Tesla, his electric car company, was burning through cash at an alarming rate. Production problems plagued the Roadster, their first vehicle, and they were hemorrhaging money with every car they built. The company was weeks, sometimes days, away from payroll default. On the other side of his empire, SpaceX wasn't faring any better. The dream of affordable space travel was crashing back to Earth, literally. The first 3 launches of their Falcon 1 rocket had all ended in spectacular failure. Each explosion was not just a technical setback. It was millions of dollars vaporized in an instant. The media began circling, branding him a failed .com millionaire playing with expensive toys. The pressure was immense. His fortune had dwindled to less than $30 million. It sounds like a lot, but for two companies with the burn rates of Tesla and SpaceX, it was practically nothing. He was broke by billionaire standards and staring into the abyss of bankruptcy. This was the moment of truth. The safe play, the logical move, would have been to cut his losses. Maybe save one company by sacrificing the other. Consolidate his remaining funds, protect what little he had left, and live to fight another day. But Elon Musk is not a man who plays it safe. Instead of retreating, he doubled down. He gathered his last remaining personal funds and made one final, desperate bet. He poured everything he had into a 4th launch for SpaceX. It was a do-or-die moment. If this rocket failed, both SpaceX and Tesla would be finished, and he would be personally bankrupt. The weight of his dreams, his reputation, and the jobs of hundreds of employees all rested on this single launch. On September 28, 2008, the Falcon 1 rocket lifted off from the Kwajalein atoll. This time, it did not explode. It soared, flawlessly, into orbit. It was the first privately funded liquid-fueled rocket to do so. That single success changed everything. It was the proof of concept the world needed to see. Shortly after, in a stunning turn of events, NASA awarded SpaceX a massive $1.6 billion contract to resupply the International Space Station. The lifeline had arrived. The cash infusion from the NASA deal not only saved SpaceX but also gave Musk the credibility and capital to secure the funding needed to save Tesla, just in the nick of time. He had stared into the abyss and, through an act of extreme, focused risk, had pulled himself back. This dramatic story reveals the core principles of Musk's financial strategy, a set of rules that defy conventional wisdom. The first and most critical is his rejection of diversification. Financial advisors preach diversification as the golden rule. Don't put all your eggs in one basket. It's a strategy for wealth preservation. But Musk isn't interested in preservation. He's interested in creation. He believes that true breakthroughs, the kind that generate exponential returns, require intense, obsessive focus. Spreading your resources too thin, in his view, results in mediocre outcomes across the board. By concentrating all his capital and, more importantly, all his mental energy on Tesla and SpaceX, he was able to push through barriers that a more diversified, less focused entrepreneur would have abandoned. He believes diversification protects you from ignorance, but if you truly understand an industry and have a high conviction in your vision, concentration is the path to extraordinary wealth. The second rule is the strategic use of debt. While he risked his own personal capital to the point of near extinction, Musk is not shy about using other people's money to fuel his ambitions. Both Tesla and SpaceX have raised billions of dollars in debt and equity financing. For Musk, debt is not a sign of personal financial weakness. It is a strategic tool for leverage and growth. It allows him to amplify his vision and scale his operations at a pace that would be impossible with personal funds alone. However, this is calculated leverage. He takes on debt for his companies, which are engines of production and innovation, not for personal consumption. This leads to his third rule, a conspicuous avoidance of luxury spending. Despite his immense wealth, Musk is famously frugal in his personal life. He's known for not owning a primary residence, preferring to stay with friends. He doesn't spend lavishly on yachts or extravagant possessions. Why? Because every dollar spent on a depreciating luxury item is a dollar that cannot be invested into a company that can grow in value exponentially. His lifestyle reflects his core belief: money's highest purpose is to build, not to consume. Perhaps the most defining principle of Musk's financial philosophy is his long-term perspective. He operates on timelines that span decades, even centuries. When he started SpaceX, the goal wasn't a quick flip or a quarterly earnings beat. It was to make humanity a multi-planetary species. This long-term vision allows him to endure short-term pain, market volatility, and relentless criticism. While Wall Street obsesses over the next 3 months, Musk is planning for the next 30 years. This patience is a superpower in a world addicted to instant gratification. He understands that building truly revolutionary companies is a marathon, not a sprint. It requires sacrificing present comfort for a future that may seem impossibly distant. This is directly tied to his preference for ownership over salary. Musk has famously taken a minimal salary from Tesla for years. His compensation is tied almost entirely to the company's performance and stock price. This aligns his interests perfectly with those of his shareholders. He wins only when the company wins, reinforcing his focus on creating long-term value rather than extracting short-term cash. So, what can we learn from this? Elon Musk's money rules are not for the faint of heart. They are not a safe, easy path to wealth. They involve a level of risk and personal sacrifice that most people would, and probably should, find terrifying. Following his path directly is not the lesson here. To do so without his specific knowledge, conviction, and appetite for extreme risk would be a recipe for disaster. The real lesson is deeper. It's about understanding the fundamental relationship between value, risk, and wealth. Musk's story proves that fortune doesn't favor the timid. It rewards those who create tangible value for society. It rewards patience and a long-term vision in an impatient world. And it rewards those who don't just take risks, but who deeply understand the risks they are taking and manage them with intense, focused intelligence. The real question is not whether you can copy Elon Musk. The real question is, how much risk are you willing to understand, to manage, and to bear in pursuit of your own extraordinary outcome? Subscribe for more real money intelligence.